It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. The high valuations in the S&P 500 continue to make news. This is something we cannot ignore. I know a lot of people have been reaching out to me, asking questions, expressing concern, rightly so, I think, in many cases. It's certainly something that should be paid attention to and not ignored. And here's a little bit more information about this that I think you'll find quite interesting. First of all, you have the PE ratios. So this is a price to earning ratio, one of the most common ways to measure the value of a stock. Currently, the S&P 500 valuations in terms of PE ratio are some of the highest levels ever recorded. This goes back well over 100 years. Even higher than the dot-com bubble, even higher than 1929 bubble that occurred before the Great Depression. This is the highest we've ever seen. Folks, this is history we're witnessing. But currently, 27% of the S&P 500 have companies with a PE ratio of above 50. Now, 50 is extraordinarily high. In fact, two-thirds of the S&P 500 has a PE ratio above 30. 30 is considered overvalued for the most part, 95% of the time at least. So we have about a quarter of the S&P 500 literally at near double the levels of what's considered extreme high end of valuations. That's how extreme this is. In fact, interestingly, there is literally only one company, one stock in the S&P 500 that has a PE ratio below 10. That happens to be Comcast. Now, I looked it up. I was just curious because what's happened to Comcast? Well, in 2023, it got hammered. I'm not sure why. I didn't have enough time to determine the reasons why, but I find it interesting that literally 499 of the S&P 500 stocks are at what's considered high valuation levels, let's say 20 to 25 times or higher. Two-thirds are at levels above 30, which is considered typically extreme high valuations, and 27% are over 50. That is incredible, absolutely incredibly high valuations and reasons to be concerned, frankly. You want to pay attention to this. You don't want to ignore it. Another way to measure it is the Shiller PE ratio. Now, what's interesting about the Shiller PE, it averages out over a period of 10 years. So it tends to smooth out the extremes, both to the up and the downside. And the Shiller PE has now hit 38 times, which is the highest it's ever been since the dot-com bubble when it briefly broke above 40, getting close on the Shiller PE of hitting the all-time highs ever recorded. In comparison, the Shiller PE in 1929 hit 32, so we're well above those numbers. We're at the second highest level ever. The Shiller PE measures over a 10-year period, so the lower PE ratios before just hadn't had time to catch up. The averages is what it boils down to. Now, the current PE ratio of the Shiller at 38 times is higher than 96% of the time in the history of the stock market. This is going back to the late 1800s. So this is history in action that we're witnessing. And this was interesting, I found too, the S&P 500 price to book value ratio. In other words, what is the book value of these companies versus their stock price? It is now at an all-time high at 5.3 times. The stock value is 5.3 times higher than what it's actually worth. An accountant would call book value if it was to liquidate. Again, to compare, the past time that it was anywhere near this number was in the 2000 dot-com bubble, where it did hit 5.1. It's never been anywhere near above 2 at any previous time other than the dot-com bubble and now. And here's another warning I find interesting. Relative strength. Relative strength basically measures the valuation of a stock relative to the norm. And you have a high and a low range in relative strength. This is something that's been tracked now since this 1960, actually. And if we go back in time, the highest relative strength periods were in one of the highest ones we've ever had. And it typically will hit more than once. It'll like hit a high point and then another high point, maybe 2 or 3 even. You look at the charts in history, what's interesting is you have the first high point, the peak, maybe a year or so later, it'll hit another peak, but that's a little lower, and then another peak that's a little lower. That's how it kind of repeats its cycle. We're seeing the same kind of thing where in 2019, the relative strength hit the highest level ever recorded. It's hit a few peaks, actually two previous peaks, but were both lower. And every time this has happened before, 1967, 2000, and 2008, this same pattern of a high peak, slightly less peak, slightly less peak, then there's been a significant correction thereafter. Most of these corrections have been in the tune of around 50% plus. Is history going to repeat itself? We will find out. There's two more key points that I find extremely interesting and valuable and important to follow. And the next one is the LEI versus SPX. And what that is the leading economic index to the S&P 500. Now, the leading economic index is an indicator of the economy. It's an economic measure. If we go back to the charts, back to like 1960, again, we're looking at historic times, so we got to go a long ways back. The leading economic indicators, when it has hit a high, which occurred 5 times prior since 1960. Each time it's done that, I'm looking at the chart as we speak. By the way, I'm going to post some of these charts on the yourpersonalbank.com website. You can go to that and listen to this or pass it on to anyone, but you can listen to this show or any of the previously recorded shows or the Your Personal Bank app for that matter. Each has its own title. Listen to anything that you find interesting. And if you have any questions or want more information or want to learn more about how to reduce your risk, contact me, yourpersonalbank.com. Anyway, the point is about this chart, the LEI versus SPX, that's leading economic indicators versus the S&P 500. The leading economic indicator has dived down, and usually when it goes down for a 2 or 3 year period. And each time it does that, we have gone into a recession. Also, each of those times, shortly thereafter, the stock market has gone into a significant correction. Each of these corrections since 1960, the smallest was 20% and the largest was 56% top to bottom drop. What's interesting and concerning is the leading economic indicators have been on a decline for about 3 years, which is one of the longest time frames we've ever experienced. Most of them are about 2 years or so. So the leading economic indicators have been consistently going down while at the same time the S&P 500 has continued to go up. It's like a cross pattern. That's called a divergence. So one indicator, the S&P 500 is climbing while the leading economic indicators is declining. We are now at one of the largest periods of divergence. That's what it's called, where there's a gap between the two because, again, the S&P 500 keeps climbing while the leading economic indicators keeps dropping, creating a gap, a bigger and bigger gap as we move forward. Well, we're at one of the largest gaps we have ever seen in history. It's a disconnect. I'm not saying this chart or this situation absolutely guarantees a market correction, but what I am saying it's worth paying attention to, and it's never been wrong previously, the previous 5 times since 1960. The last one that I want to bring up that I find concerning is one of the biggest drivers of the stock market rally that we've seen over the last couple of years. We all know is the AI boom, the bubble, some people are calling it. But there's another thing behind this that most people are not aware of, and that is margin debt. Now, if you're not familiar, what that means is you can purchase stocks on margin, which means you're borrowing money, you're leveraging to buy more stock. So a lot of these individuals and institutions are not only buying the stocks, but they're actually borrowing money to buy the stocks, so therefore leveraging their positions, which is far more risky of a position versus just purchasing the stock. Now, whether you're buying on margin or not is kind of immaterial. Obviously, if you're buying on margin, you're at a higher risk position than someone that's not, because it's going to accelerate your moves both to the upside and the downside, which by definition increases risk. But when you have a significant amount of investors using margin and you see movements in the market, this can accelerate or accentuate or exaggerate moves, like both to the up and to the downside. And what we've seen in the past year is margin debt has now topped $1 trillion. But what's more concerning, that it has ballooned 25% over just the past year. In other words, a full 1/5 of all the margin debt, the money that's been used to borrow to buy stock, has been done so just in the past year alone. And half of it's been done in the last 5 years. Exaggerated. We've never seen levels like this. This exaggerates the move. We've rarely seen levels of margin like this, which also makes it quite risky or quite scary. If somebody's borrowed money to purchase stock on margin, which is what they're doing, they're borrowing money, and that stock's price starts to move against them, the broker, they are going to experience something called a margin call if it goes in the wrong direction. Now, I've experienced some of these things myself personally. I can tell you way back when, it's not a fun experience, because if you can borrow up to a certain percentage of the value of your stocks, but if it drops too far, too fast, you're going to get a margin call. In other words, the broker is going to say, hey, you've got to sell the position and potentially bring us more money in, and you have 24 hours to do so. Margin calls can get ugly really quickly, really fast. If values start to drop and they're margined, so they're leveraged, they've leveraged the risk, and things move, it exaggerates the move, and that's where panic selling comes in, because you can have almost like an unlimited downside to your risk on the margin, and you can end up owing the broker more than what you have invested, literally, like even 2 and 3 times more. In fact, this can be really exaggerated, really significant, and really ugly really fast. That's why you see some of these moves occur so quickly as they do. So we're seeing historic levels of valuations. We're seeing historic levels of leverage, margins. The risk is elevated. I can't stress this enough that you need to be aware of this. Now, look, if you're okay with all this risk and it drops in half and you're not going to bat an eye, okay, that's fine. That's your position. But I can tell you most people are not in that position. Those types of things occur, and they're going to occur quickly, and that concerns you. You might want to reduce your risk. Take some of the risk off the table. This is a golden age of fixed assets. I'm going to talk about this some more as we go forward. I've got some more information in the next segment. But if you want to move some of the risk off the table, obtain gains, unlimited upside, by the way, if the markets do continue to go up while protecting the downside, I was guaranteeing the principal. It's never been a better time in 40 years with annuities, for example. Your personal bank dividends are great.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. One of the reasons I've been getting more and more adamant about the risks that many people are facing with their portfolios is because of this AI bubble. Seen it before, been on this rodeo before. We are at all-time high historic valuations on many of the stocks, particularly the S&P 500, particularly the tech stocks, the AI boom. This is what's been driving all this. We are seeing valuations and numbers we have never seen before, ever in the history of the stock market. This is going back literally like 150 years. Highest levels we've seen since 1929 or 1999 for that matter. I can't stress enough how historic this is. And if you're not aware or paying close attention, it could really come back to bite you. And what I'm getting at is, I have said this for a while now, is what's the trigger? What's the catalyst? What's going to cause the correction to, because a correction is going to occur. What's going to cause it to occur? And no one knows that, but maybe, just maybe, we're starting to see the beginning of that. And what I mean by this is Sam Altman, who's the CEO of ChatGPT and other things, recently warned of a bubble in AI. And there was an MIT study that doubts the hype of the AI claims. The problem is that a recent MIT study attributed failures to incorporate learning gaps and flawed integration in AI models. As Sam Altman put it, he said, we're running against a wall, and they experienced that with ChatGPT 4.0. Recently, they came out with the 5.0 version, and it was touted to be the next level. You know, many people were expecting a leap forward in terms of capability and, you know, all the knowledge and everything else. And it was an absolute catastrophic failure. In fact, in many ways, for example, mathematically and things like that, it was the 5.0 version was worse than the 4.0. It was so bad that the company pulled it from the market. And as Sam Altman has pointed out, he's warned there's a potential bubble. He has stated that the MIT study claimed 95% of companies have seen no returns from generative AI. And Sam Altman himself has said we're hitting a wall. And part of it is the computing power. He has come out and stated recently that we would need to invest in trillions of dollars of electrical generation to be able to fuel the AI. I've even seen things recently where they're recommending that instead of doing an AI search online, just do a Google search, because the AI search requires 10 times the electricity or power than a typical Google search requires. Folks, we just don't have the electrical power to power that. And as he pointed out, we're hitting a wall. Now, I'm not going to say that AI is not going to continue to grow and learn, but they are hitting a wall in terms of the ability to grow and learn based on the amount of computing power and electricity that they have available. I've shared on the show several times in the last few weeks in particular where, because this bubble, this hype with AI has been so extraordinary and we have these extraordinarily high valuations, any challenge, delay, frustration, whatever is going to cause disappointment, which will likely cause stock valuations to drop. And they could drop very significantly because it's gone up so significantly. And part of the reason why I say this is some of it's human nature, some of it's just looking at history, some of it's looking at cycles, some of it's at previous experience. This is my 25th year doing this. And some of it is I saw this before in the dot-com hype. Mark Twain, I think, was famous for saying history doesn't repeat itself, but often rhymes. It's amazing to me how similar this AI hype has been compared to the dot-com hype. And the hype back then was, that the internet would fundamentally change the economy. And of course it did. But here was the problem. It didn't happen until about a decade later. It took a while to work through the problems, the challenges, and to get general acceptance by the public. It was a combination of things. And I believe this could be the beginning of what we're starting to see, those problems, those challenges, those delays in incorporating this new technology that might end up, eventually I believe it will fundamentally change the economy. Don't get me wrong, but it might take a lot longer. And even Sam Altman is now saying that, not just me, and MIT are saying that much of this may take a lot longer than people's expectations, which is going to create some major disappointment. In fact, just from Sam Altman's statements, just this past week or so, we had started to see a sell-off on stocks in a lot of major AI stocks. In fact, Planeteer fell like 10%, I believe, in a day. I mean, that just gives you an idea of how significant just even a mild challenge disappointment could cause significant drops in valuation. And because we're so concentrated, the S&P 500, as I shared earlier and also last week's show, if you missed it, go to yourpersonalbank.com. You can listen to this or any of the previously recorded shows anytime you want. You also can go to the Your Personal Bank app. They all have their own title, so you can listen to anything that's interesting. But I was sharing this last week where what if the delay or frustration turns out to be even bigger? The frustration can build, the delay can build, and obviously we'll see drops in valuations. Many of these are just in a handful of stocks, so this could be huge if that indeed does occur. We're already starting to see the beginning of a drop-off. Is this the beginning of the burst of the AI hype bubble? I don't know yet, and I don't think anyone knows that yet, but it could be. And you want to be very cognizant of this, pay very close attention, particularly if you're invested. And a lot of people say, I'm not invested in those high-flying tech stocks. Well, you probably are more than you realize. Why do I say that? Well, the significant portion, again, I shared this last week's show, the valuation of the S&P 500 is in just the top 10 tech companies, something like 40%. So if you own a S&P 500 index fund, for example, about 40% of that fund's valuation is just in 10 companies. And about 15% of it is just in 2 companies, NVIDIA and Microsoft. So a reduction in either of those companies or just a handful of those companies could cause major loss of valuation of your portfolio. It's kind of like the old analogy. You don't want to put all your eggs in one basket. That just is way too much risk for most people and is typically not recommended. As a result of this testimony from Sam Altman and this MIT study, I'm suddenly seeing articles all over the place, like titles of saying the warning signs the AI bubble is about to burst. They're coming up everywhere. This article comes out from Barron's. In fact, it was published March of 2000. The title was, "When Will the Internet Bubble Burst? The unpleasant popping sound is likely to be heard before the end of this year." That turned out to be very accurate because the NASDAQ dropped 65% from its highs. Now they're saying on Wall Street, many are fearing that unpleasant popping sound may be imminent for the AI boom. This was blasphemy even a few weeks ago in a lot of circles. But I'm not here to tell you necessarily what you want to hear. I always say this when I'm working with a client or a potential client and I look at their situation or they're asking for advice. I'll say with a smile, well, do you want me to tell you what you want to hear or what you need to hear? I'm not saying that the market's not going to go up from here. It could. What I am saying is the risk is highly elevated to the point of all-time levels risk of elevation of a correction. And that correction could be very significant because of the level of the increase, the highest increase in history, and the concentration just literally in a couple handfuls of stocks. So this could cascade and could cascade quite quickly is what I'm trying to help you understand. The key points about this MIT study that I think you'll find very interesting. They point out that since the launch of ChatGPT in 2022, Silicon Valley's been evangelical, if you will, that AI chatbots will transform the economy. Many companies have invested billions in the tools for their staff as a result and predicted massive cost savings. The MIT report has stated the promised AI revolution has stalled. After surveying hundreds of businesses and employees, MIT found that just 5% of integrated AI pilots were extracting value, while the vast majority remained stuck with no measurable P&L or profit and loss impact. 95% of this AI projection, cost savings, productivity enhancements has so far not come to pass. The study even went on and stated that enterprise-grade systems were being quietly rejected now by major businesses. Only 20% have now reached pilot stage and only 5% have gone to production. Companies are starting to recognize that AI is not ready for prime time yet. It's just not ready. I believe it will be. It's just a matter of time. When that may be, no one knows. But clearly, it's not now. And that's the point I've been trying to make is apparently a bigger and bigger disconnect is becoming apparent. Why? Well, the promises were made were incredibly high. And why would Silicon Valley do that? Again, you have young, entrepreneurial, creative types who are trying to raise money, do startups, tell a good story. They want to attract investment, and they're going to tell the most optimistic side of that story. If everything goes right, this is what would happen. And that creates a bubble, frankly, an enthusiasm, an excitement, people wanting to jump on board. They don't want to miss out. Fear of missing out. That's one of those things that fear and greed that motivates the market, human nature, all that stuff. But unfortunately, Silicon Valley has a long history of doing this type of thing, of making big promises, yet not delivering, certainly not in the time frame. In fact, I'm going to say Silicon Valley has a history much like contractors do, where they say, hey, we're going to build this house or do this project in this time frame and in this budget, and rarely do they do it on time and under budget. In fact, it's typically the opposite. And you're building a whole new infrastructure, a whole new technology. This isn't easy. It's difficult. So I'm not going to say it's their fault per se. I'm not going to say they were lying, but they were certainly being optimistic, probably far too optimistic for reality. And it's when this reality hits is when the valuations are going to be hit too, and probably quite hard. If you want to protect yourself, you want to take some of this all-time historic risk off the table, if that's where you're at in that position, contact me at yourpersonalbank.com. It's never been a better time to invest in annuities, for example. Unlimited upside potential, no downside risk, and some of them are doing so well that with good MVAs, which is market value adjustments, their surrender charges are going away as quickly as a year or two, which has been the one limitation of annuities historically, but it's the golden age of fixed assets. We're in a different world, folks. If you want more information on that, contact me at yourpersonalbank.com. Stay tuned to the next segment. I've got a few more things about this that I think you'll find quite interesting.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. I want to go in a bit more about this MIT study because this is, as this article has pointed out, could be the cause of the bubble bursting on the AI craze. They go on and explain, even though $30 to $40 billion has been invested in generative AI in the last few years, the report uncovered a surprising result that 95% of organizations were getting zero return. As soon as this report came out, some of those stock prices dropped, understandably so. MIT is stating that the promised AI revolution has stalled. I'm not saying it's over, it's not ready, it's delayed. Sam Altman, CEO of ChatGPT, has stated, "Are investors overexcited?" My opinion is yes. He pointed out that there's a lot of people that stand to lose a phenomenal amount of money. Now, this is not the type of information you want to hear about AI, which has been driving the stock prices to all-time records, literally in 150 years, higher than 1929, higher than 1999. Some big promises have been made, and if they're not fulfilled, there's going to be a lot of frustrated people. And like Sam Altman said, a lot of people are going to lose money. Meredith Whitney is another one. She was famously called the 2008 financial crisis, by the way. And she's pointing out that there's difficulties with the economy that she's concerned about. She's very much concerned about this AI boom, believing that it's overvalued, overinflated. It's hard not to think that because, again, it's all-time highs we've ever seen. She also points out we're in a bifurcated economy where the weakest portion of the U.S. economy, which happens to employ about 20% of the U.S. workers, is hospitality and leisure. And these are jobs that generally pay under $60K and may see the biggest hits when unemployment start to worsen, as she pointed out, if we see a correction in the economy. She believes that we're likely in a really big pickle. She also thinks the housing market's headed for its worst market in a decade in terms of activity. As she pointed out, existing house sales are tracking at the lowest levels in over 25 years. Buyers are looking for steep discounts and sellers are not willing to make those discounts. Even Goldman Sachs is now turning bearish. That's the second major investment bank that is now warning of a decline. In fact, they state the risk of a stock market decline has suddenly spiked. I believe it has a lot to do with this MIT report pointing out that 95% of AI projects are not benefiting the companies at all. And this is why tech guru Eric Gordon has stated that investors will suffer far more from the AI boom than the dot-com crash. His main reason behind this is because of the greater scale. If you look at the charts, the amount of dollars and everything else, he points out if the AI boom goes bust, it will actually dwarf the dot-com crash because of just the sheer scale of it. It's so much bigger. Gordon researches financial markets and technology at the University of Michigan, and he's previously called the AI boom an order of magnitude overvaluation bubble. I thought that was quite interesting. He even points out that if you take what was called the poster bozo of the dot-com craze back in 1999, that was pets.com, and you compare that to NVIDIA-backed CoreWeave. CoreWeave is an AI startup company. CoreWeave shares have dropped 33% in 2 days. If this moves on to some of these other AI startups and these other AI type companies, Gordon points out more investors will suffer than suffered in the dot-com crash, and the suffering will be more painful. Going back to his example, pets.com was backed by Amazon. It secured a market value of $410 million at its peak. That was in February of 2000, and within a year went bankrupt. $410 million was lost. Well, CoreWeave's market cap is about 60 times larger than pets.com. So just comparing one company, for example, one AI company that's already struggling, it's lost a third of its value recently, is 60 times larger than pets.com was, which was the poster boy for the dot-com bubble and then burst. Look, I hope none of this happens, but I have to face the fact that we are at all-time highs. This is something that just, you have to know. It's been caused largely by this AI boom. Much like the dot-com craze, the hype of that caused those historic valuations. The craze, the hype, whatever you want to call it, has caused these recent all-time high valuations. Folks, this is nothing new. If you go throughout history, one of the first bubbles to burst happened in the 1500s in Holland. It's a famous example where tulips became super valuable, even at one point that some tulip bulbs were selling for more than a house at that time. And of course, that totally and completely burst eventually, and many people got hurt. I saw a chart recently with Sir Isaac Newton. Certainly, Sir Isaac Newton was an intelligent person, and he had found a stock that he liked, and he got caught up, and it was one of these new tech for its time, okay, bubbles. It went up significantly. He made some money. He sold it. He told some of his friends friends who then bought it. It shot up from there like 2-3 times. Sir Isaac Newton got frustrated, so he got back in at close to the top. And then shortly after that, it crashed significantly and he lost a ton of money. He got frustrated from that. And again, here's somebody who's very intelligent, obviously, who got caught up in the hype, because even Sir Isaac Newton, as intelligent of as a scientist and a person as he was a human being with emotions like the rest of us. And he wasn't immune from the hype and he got burned by it. I don't know who I'm talking to right now, but I'm certain there's somebody, if not several people, at least a number, who need to hear this message. You might be following the hype or listening to somebody who's encouraging you to invest, whether it's an advisor or someone else, a friend, I don't know, but you're getting caught up in the emotion and the fear of missing out and all that, fear and greed emotions, and making investment decisions based on those emotions is a recipe for disaster. Anyone will tell you that. And we all understand that logically, but it's hard to overcome emotionally. And when you've done really well and you keep winning, and you keep seeing the numbers pile up and the chips pile up, it's much like being in Vegas, or you see the numbers increase in your statements. It's hard. It's really difficult to pull back from that. It becomes a comfort zone. You get used to winning. It keeps going up, and you convince yourself, or you get caught in that emotional frenzy, if I'll even call it, where you convince yourself that it's just never going to go down. It's just going to keep going up forever. Now, obviously that doesn't occur. That's not realistic. If you've done really well, why not take some of the winnings off the table? Okay, it could go up some more from there, but you've done really, really well. Hey, keep some of it engaged if you want to grab some more of the upside, but don't leave it all there at risk, or significant portions that would impact you negatively, whether it be financially or whether it be emotionally. Look, there's some people listening that have done really well. It's exploded. And then if it took a huge hit, it wouldn't really change their lifestyle per se. I get that, but it would really bother them emotionally. But stick in their craw. That's a lot of people out there. Why put yourself in that position is what I'm trying to say. In fact, I have a client that had bought Nvidia a couple 3 years ago. And last year it shot up quite a lot in value. He decided, you know what? That's enough. I did far better than I ever expected. He quadrupled his money actually. And he said, that's it. I'm good. I'm going to get out and put my money somewhere safe, guaranteed. He put it in a personal bank policy, earning interest, dividends, guaranteed, insured, tax-free, liquid. And it took a dip from after he got out for a while, and then it went back up and shot up even higher after that. And you know what? He's still happy. He was just getting to the point, as he called it, nosebleed levels, and that's where we are now. And he goes, I just wouldn't be able to sleep that well, knowing that it could go the other way so quickly on me, quicker than I probably could get out. And I've done really well. I'm happy with that. And that's a man who's at peace with himself. He's not trying to grab every little bit of gain he can while continuing to incur more and more risk as he keeps trying to get more gain. You know what I'm trying to say? So my point is, this is a show about common sense, trying to instill a little prudence here. If you have seen significant gains, historic gains perhaps even, some of you have, awesome. Be happy, be satisfied. Take some of that off the table. Don't keep leaving it on there. Don't spin the wheel again. Don't roll the dice again with all of it at risk. Play with the house money. Take out what you've put in. So at least if it goes down, you're not losing your money, you're losing some of the gains. It's prudent, it's common sense, it's smart, it's wise money management. And to put it into something guaranteed like an annuity today, where you continue to still get unlimited upside. That's the amazing part of how much better annuities are today than they were even 2 or 3 years ago, is you have literally unlimited upside with no downside risk. In fact, once you understand that, when I have people contact me and they understand how these work, they're like, holy cow, where's this been? And it's kind of a no-brainer why I shouldn't put some money in there. I have had a number of people actually contact me who have done exactly this, and I've been in touch with them afterwards, and they're at peace with their decision. They're calmer. They just feel better. Well, I'm running on our break. I'm going to share, like I said, I've been on this business 25 years, and I've seen this rodeo before. This is like the third time, actually. I can't stress how much this run-up in the markets that we're seeing recently mirrors what I saw at the end of the dot-com run-up and the bubble and then the burst. How similar it was, how it was going on, how people were feeling, the emotions, all of it. I'm going to tell a couple stories in the next segment. I'm going to share where there were people completely and totally stressed out versus those who are just relaxed and still enjoying their life, because that is what's more important than money, peace of mind.
Stay tuned for more common sense from Ference. For more information, contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you'll reach me. It's yourpersonalbank.com. I've been discussing on today's show how overvalued the stock market is, particularly the S&P 500, particularly the tech sector, and most particularly the AI segment of that. Recently, an MIT study has come out stating that 95% of companies that have instituted AI have seen zero benefit or result. They were shocked by those findings themselves. This has thrown some doubt in terms of whether the AI revolution is continuing at a pace that we have come to expect or what was promised by Silicon Valley and what investors were expecting. Sam Altman, the CEO of ChatGPT, has stated, or OpenAI, has stated, when bubbles happen, smart people get overexcited about a kernel of truth. He's discussing how we are definitely in a bubble. It's insane that AI startups consisting of 3 people and idea are receiving huge amounts of money with incredibly high company valuations, and it's not rational behavior. He said someone's going to lose a phenomenal amount of money. We don't know who, but it's going to be a lot of people because so many of these companies are affected by the AI craze. So much of the S&P 500 valuation is in like the top 10 tech companies, like 40% of it. So even people that are not necessarily invested in the AI portion or the tech portion are still going to be impacted, even if they just have an S&P 500 fund, for example. The point Sam Altman was making is that AI's come to a plateau, or they're running into some barriers, and it has to do, like he stated, with their failure of 5.0 versus 4.0 not being better. In fact, it was worse. They had to take it off the market, ChatGPT that was. Part of it had to do with computing power and having enough electricity. As he stated, it's going to have to invest trillions of dollars of infrastructure. They screwed up the ChatGPT 5 launch, and they're going to have to spend trillions of dollars on data centers to make it work right. And that's going to take some time and a lot of money. He even went on and pointed out that the limiting factor is hardware. Sam Altman revealed that OpenAI has models more advanced than ChatGPT 5, but can't deploy them broadly. He says, we have better models. We just can't offer them because we don't have the capacity. GPUs and electric power is in short supply. It limits the company's ability to scale. This is super important to understand. The AI bubble has been caused by some very high expectations. And I've stated often on this show that if there's any delay or frustration, these historic high valuations in the stocks, the S&P 500 and all that, are going to be largely negatively affected because of the historic run-up. This all falls on top of the fact that a lot of the data center that has been used to fuel these AI companies is already being used. For example, data centers in Virginia just last year used a quarter of all of the power generated by the state of Virginia, the entire electrical grid. Our electric grid as it stands now is no position to produce the type of level of computing power that they need to make the next leaps forward in AI. That's the limiting factor. That's the challenge. The infrastructure needs to be built out, and that's not going to happen overnight. I'm not saying it's not going to happen. I'm saying it's going to take time. And that's something a lot of investors are not factoring in, or we're not factoring in with these sky-high valuations, expecting these companies to just make massive profits. The MIT study recently pointed out that 95% of the applications have failed to benefit the companies at all. Zero benefit. That's not good news when you consider $30 to $40 billion has been spent by these companies. And so now what's happening, many of them are stepping back on instituting AI into their company. That's just going to cause a further delay in everything because, again, they're realizing it's just not ready. It's not ready for prime time or to be taken to the next level. These articles that point out, will this bubble, it's going to burst at some point. They all do. Is it going to look more like 2009? Or will it look more like 1968? Because those are the last two major run-ups in the stock market. The 2009 was hard and fast and brutal. It had a massive drawdown, and it happened quickly. The 1968 one had more peaks and valleys. It took longer. So The point of this article really isn't if we'll have a correction, but how it will end. Will it look more like a series of smaller peaks and deeper pullbacks, or something more aggressive and hard and fast like after 1999? We'll see. So what do you do? Some people say, well, cryptocurrency might be the solution. Maybe. But if you look at a chart of Bitcoin, which has hit all-time highs recently, and you look at a chart of the NASDAQ 100, for example, it's hard to see how they're very much different from each other. In fact, it's amazing at how much they mirror each other since 2020. And the point of this article was, if you look at this, it basically looks like Bitcoin is a leveraged NASDAQ ETF. And if the NASDAQ drops, well, Bitcoin will too, probably, and even more so. Here's another thing to understand about Bitcoin in particular. Do you realize if you go back about every 4 years, Bitcoin has lost value? The average drop in the value has been about 70%. And guess which year we're in now? Folks, this is year 4. So if Bitcoin continues to follow the pattern that it has for the last, 15 years plus, we're likely looking at another pullback. And if history repeats itself or rhymes, we'll see about a 70% pullback from the highs. Just saying, be aware of this. And then some people say, well, what about precious metals? There's a lot of emotion involved with precious metals, particularly gold and silver. But I'm not saying I'm totally against those things, don't get me wrong. It can be a hedge against inflation, certainly. But here's one of the major challenges with precious metals, and that is they don't generate income. I was talking to a client this past week where they had a significant amount of money in precious metals. They were getting ready to retire, and the problem they had is no way to generate enough income to live on in retirement. You've heard the old saying, if your house rich and cash poor. This gentleman was precious metals rich, but income poor. So he's now looking at selling some of that. Now, granted, it's gone up in value, so it did appreciate. So that's not a bad thing. Don't get me wrong. It can be something to hedge. It can be something that can appreciate in value, but it's not something that'll generate income. So precious metals may be a solution, may not. It just depends on your situation and what your needs are. And as I pointed out to him and he agreed, I'm not in agreement with those who spout that precious metals are beneficial for, say, a catastrophic failure of the economic system. If we get into something where we have catastrophic failure, I'll use a great example. I have distant relatives that live in Western Ukraine. Okay, that's a catastrophic situation there. They had a home and business in Kyiv and lost both to the war. I can assure you, those folks were not concerned about yellow metal. What they were concerned about was water, food, shelter, medicine. Okay, so if we're talking about catastrophic economic situations, precious metals are not going to be the panacea. Okay, it can be a good hedge against inflation, that type of thing. Most, if you're going to do it, recommend 5, maybe 10% of your total portfolio for those purposes. You don't want to have a significant amount there, too much, and it certainly will not create income if that is a need of yours. I think one of the best solutions really comes back to fixed assets right now. We're in a different economy. Bonds. Interestingly, a lot of people think that bond rates yields are going to go down if the Fed drops interest rates. I don't think so, and I've got some evidence to point this out. For example, it turns out the UK has dropped their rates, I believe, about 5 times in the past year or so, yet their bond rates continue to rise. Why? UK has similar problems in the US in terms of government debt. You see, it's not the Fed or the central banks that are driving interest rates anymore. Yes, they were for most of the previous decade, and they were pushing them to artificial lows. Lowest interest rate environment we ever saw in the history of the United States for the longest period of time. That's a statistical fact. The Federal Reserve is driving the bus. It's now the bond market that's driving the bus. And what's driving the yields, the interest rates on the bonds, is the high levels of debt. So even though in the UK we are seeing reducing interest rates, the central bank reducing rates, the bond yields are not going down. In fact, they're still going up. And I believe we'll see something similar here too if indeed the Fed does drop rates. In fact, if you remember in November, I think it was October of 2024, the Federal Reserve dropped interest rates 0.5 point. And if you go back and look, what did bond yields do? They actually went up. So we saw the same thing happen here in the US, again, because of high levels of debt. That's the reason behind it. That situation is not going to change anytime in the near future. I don't see our federal government paying down debt anytime in the near future. And in fact, if anything, it's going to get worse before it gets better, before we get to a crisis situation, likely. So in the meantime, why not take advantage of that? Increasing interest rates, increasing yields, increasing dividends, increasing returns with fixed assets. Guaranteed against losses, many times either tax deferred or even tax free. And I can show you how it can be highly liquid as little as 30 days, others in a year or two, depending on what you're looking for. This is the golden era of fixed assets. There has never been a better time in our lifetime to invest in a fixed asset, and you can eliminate the risk of a potential correction from a bursting of the AI bubble when that occurs. And that could be a significant one. Why not just get out of the way? If you want more information, contact me at yourpersonalbank.com. Stay tuned to the Your Personal Bank Show next week for more great information. And as long as it's on our money, in God we trust.
Listen Tuesdays at noon and Saturdays at 1 to the Your Personal Bank Show for more information. Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Dividend rates and bank line of credit rates may change. For current rates, contact Ference at 866-268-4422 or yourpersonalbank.com. Again, that's 866-268-4422 or yourpersonalbank.com.